Hello and welcome to Switzer TV. I'm Peter Switzer, and tonight we look at 5 companies on a tear higher on the market right now. Those companies are Tyro, Zipco, EML, McPherson and Elmo. Mike Wayne of Medallion Financial will assess each company one at a time, and then Mike Gable from Fairmont Equities looks at what the charts are telling us about these companies. As I say, these companies have been on a real tear higher. And then we'll talk to Charlie Aiken and Paul Rickard about how come the stock market is going up despite there has to be some fears about a second wave sell-off. Well, that's the show, and without any further ado, let's go and check out Julia Lee and what she's up to right now. Well, joining us as she always does to kick off the show is Julia Lee from Birmingham Invest.
Great to be here, Pete.
Now that market just keeps on going up, Julia. I'm just praying there is no second wave infections, because it seems to me the market is believing that if there are going to be second wave infections, they're not going to rock the market. What do you think?
This is a market that's rallying on the basis that we're going to see an easing of the lockdowns, not only here in Australia, but also in New Zealand. In fact, we heard that New Zealand from this Thursday will be opening up their bars and restaurants, so people will be able to go out. They will limit gatherings to 10 people, but the lifting of those restrictions means some of those New Zealand stocks did well on the market. Sky City, which has a casino in Auckland, was up by about 5%. We also saw Auckland Airports up about 4.5%, and New Zealand was up about 3.5%. And even Fletcher Building managed some gains on hopes that its workforce will be able to get back to work. And of course, here in Australia, with the easing of some of the lockdowns, it meant that retailers did well on the market. So I think Myer was up by 13%, JB Hi-Fi was up by about 3%, and those discretionary retailers did well on the market today.
Now, Julia, what have you been buying and why?
Well, I think, Pete, last week I told you I've been buying into stocks where the solvency and liquidity concerns disappeared, so basically after capital raisings. And some of the stocks that we'd entered into included things like Webjet, G8 Education, InvoCare, as well as QB Insurance. And some of these stocks have really taken off. I guess I bought them when it was at peak pessimism. And Webjet today on the market was up by more than 20%. So some of these stocks are now starting to factor in that people will start moving and traveling again. And we are starting to see an uplift in terms of valuations there. So that's nice to see, as long as we don't get that second wave, Pete.
Yeah, that's right. And I know we interviewed the CEO of Webjet here about 6 weeks ago, and he thought the coronavirus would be a problem for him. I don't think he could ever imagine how big it was, but he'd be very happy to see this bounce back. What about, so it's Webjet, GEM, that's the education business, right? And NAB, you bought that because they're having a capital raise?
After the capital raising, they strengthened their balance sheet, so they should be okay in terms of capital over the next 12 months, and managed to get that dividend as well. So that was a nice bonus. Look, the banks are cutting or deferring dividends at the moment. And even if we did see deferred dividends or cut dividends over the next 3 years, I guess picking up stocks for the longer term, as long as we see a recovery of those dividends over the next 3 or 4 years back to pre-COVID-19 levels, then, based on current prices, you're looking at a yield of 13 to 15%. So unusual circumstances, but also an opportunity there. No doubt that in terms of the housing market, the pain is probably yet to come, given those mortgage deferrals, but given where stock prices in, the prices now probably are reflecting that.
So are you basically saying that if you're a long-term investor, looking at some of our banks is not a bad idea?
I think the banks looking interesting. Virgin Money is another one that's been sold off very heavily. The other area that's looking like it's been indiscriminately sold off is the real estate investment trust area. And I guess today's update, we heard from Accenture as well as from Charter Hall Wales. And I think comparing these two companies really highlights the difference in quality as well as tenancy. For Accenture, which is the Westfield shopping centres here in Australia, it has been heavily hit outside of the supermarket and food retail, things like footwear, clothing, leisure. They've been hit very hard. And they're saying at the moment around about 57% of their tenants are open for business. That will slowly ramp up. But then you compare that something to a Chatham Halls Whale, which is a much diversified portfolio, and most of its income comes from government and large corporations. A few years back, they bought the Telstra Exchange Towers, which they now lease back to Telstra. They've got a BP portfolio as well. So much more stable. They came out with a revaluation to more than 40% of their portfolio because some of the assets are unlisted, and revaluations didn't move. They are going to reevaluate 100% of their portfolio by June 30, but pretty stable cash flows for a business like that, with the average lease 14 and a half years and on a yield of 6.3% in a world where many dividends are being cancelled, deferred, or even dropped. It's looking pretty attractive at the moment. So the real estate investment trust is one of those areas where everything's been sold off, but there's pockets of quality because of the quality of the tenants, the stability of the cash flow, as well as the assets.
Yeah, I know John McBain from Centuria was basically saying the same to us last week, that basically he's very happy with his portfolio of clients or tenants, and they're probably, he didn't say this, but probably like you're implying, that they have been oversold. And I guess as the market recovers, you'll be getting reasonable income along the way as well.
Yeah, I mean, yield is a hard question at the moment for a lot of investors, given the typically high yielding areas of the market, like the banks, have been cutting or cancelling or deferring dividends. So yield really is coming from unusual places on the Australian market, from the miners, from the gold miners, from areas that you wouldn't necessarily expect. There are still some traditional pockets of yield, so the supermarkets are still doing relatively well with stable cash flows, and the utilities, but really a lot of that dividend growth for the Aussie share market is coming from the miners.
You're still buying gold, Julia, or have you got enough gold?
I have enough gold, but Evolution's one that I've liked for a while, and I think that's up 8% over the past week, and looks like it's ready to test all-time record highs. So interesting one. Still like it. I mean, when you're selling the gold at over 2,600 Australian an ounce, and your all-in sustaining cost is below 1,000, $1,600 is a pretty nice margin to have as a gold miner.
And Julia, in the past you've liked EML payments, and we've looked at it on the program, later in the program. What's your view on EML nowadays?
Well, the outlook is brightening. We have seen retailers doing well on the market, the buy now, pay later space doing well, and that's all on the basis of the economy starting to rumble and open up. So EML, which is in the area of gift cards as well as rechargeable cards, are doing well, and hopefully we do see the economy opening up before that key Christmas period for EML. So EML share price reflecting that better outlook for its business, given that we are seeing some things in Australia opening up.
Yeah, Julia, I'm glad that you come and open up for us on all the things that you're buying, because it's very good for our investing going forward.
Thanks, Pete.
What do you think about a company called Zipco?
Yeah, so Zip, this is the much vaunted buy now, pay later space.
Yeah, little brother of Afterpay.
Little brother of Afterpay. Look, both Afterpay was down below $10 at one point, ended up close to 40. Zip Money was, I think, around $1. It's now back above sort of $3.50. Initially, everyone was fearful with these companies that people being laid off, people being unable to work, they'd have no money to spend.
No retail.
No retail at all. As it's turned out, these companies have given a couple of updates, and so far they haven't been too bad. Obviously, bad debts have ticked up, but it's only been very slightly in the case of Zip Money or Zipco. So far, there hasn't been too much damage to their overall business, but it's something you've got to keep an eye on. For us, it's not somewhere that we're invested in at the moment just because of that unknown factor. Would have liked to have got in on the pullback.
So when you have an unknown factor, you just kind of put that to the side until that unknown becomes a known, or?
Basically, when it's such a big key issue for the company, I think it's something you need to take into consideration, because So far, the government programs have obviously helped in reducing the number of defaults and bad debts out there for these sorts of companies. JobKeeper, JobSeeker, that is injecting a lot of capital and cash into the system that won't necessarily always be there.
Yep.
You've got to consider as well, with the likes of Afterpay and Zip, in order for them to keep growing, they need to keep getting access to capital. And debt funding costs have gone up around the world. If they'll have to come and raise equity in the market, the cost of equity has gone up probably as well. So their costs are going up and they can't necessarily pass that on to their end customer or their merchants the way that a bank would. So for us, it's still a lot of questions to be asked. And I don't think you can compare Afterpay and Zip as a like for like all the time. I think Afterpay is probably slightly better quality. Their repayment turnover is a bit higher than Zip, but Zip has actually been seeing that repayment turnover pick up a little bit.
Yeah. I must admit, I've avoided Afterpay because I didn't know what governments might do to stop them doing what they're doing. And Zip actually is probably a better advancer of credit. They don't give away credit as willy-nilly as Afterpay, but they have a spectacular growth.
Well, that's right. So they do bigger ticket items. They're a bit stricter in the way that they do background checks, etc., and that has probably hindered their rates of growth.
Nice guys come second. Let's go to the next one. EML Payments is one that our good friend Julia Lee has liked. What do you think about EML Payments?
Look, another interesting, fast-growing tech business. It makes a lot of sense. This company, in the areas that it's operating in, has been taking market share and growing at spectacular numbers. They pulled back as well very quickly when the initial sell-off was taking place, but they've bounced equally as quickly. So you've got to be quick with some of these growth stocks to take advantage of them. EML has basically got three business divisions. The first one is reloadable credit cards, which are used for various sports betting accounts, such as Ladbrokes. I shouldn't probably go through the names on this, but anyway.
Okay, that's a good example.
But so that's the first business. The second one is gift cards. So you think about your old-fashioned Myer gift card or David Jones shopping centre. Again, I'm going through the different brands there, so giving them a free plug. But basically, that's the first two businesses. The third one is secure payments between businesses and their suppliers, etc.
And these guys should be struggling now, shouldn't
That's
they? Because
right.
people aren't out shopping, but they're still got to bounce.
That's right, and that's what I don't quite understand, and that's why I'm a little bit cautious of just piling into them, because the share price is moving higher. That's one aspect to it, but the underlying business at some stage needs to show that it can handle these conditions, because you would think that reloadable credit cards, gift cards and business transactions would all be under pressure.
Yeah.
Prior to the COVID-19, as I was mentioning, all the numbers were moving in the right direction. They've done a lot of acquisitions. They've managed to integrate those quite nicely. They're still growing organically as well, so not just through acquisition. So there's a lot to like about this business, but there's a lot of unanswered questions.
Do you think some speculators are saying that we might come out of this faster than we think? A company like this will rebound quicker because, like in retail, it's in casinos and things like that? That's
right, and that's what people try to do with stocks. They view something that's temporary as permanent sometimes, but in this situation, they're viewing this as a temporary issue that's going to be transitory and pass in time, and then in 6-12 months, we might not get back to 100% of the volumes and the values that were being transacted previously, but we'll be pretty much there 80-90% of the way back.
Okay, let's go to Tyro. Now, Tyro is a company that was once a $4 stock, ripped up there, it got clobbered down to about $1 when the crunch was on. It's now made a very big comeback. I think it's up a fair bit today as well. What's your view on Tyro?
Another great fintech company, a good story that actually made that transition from a specky, if you like, to a company that won a lot of contracts and generated a very strong business model, taking market share away from the banks.
And it's basically what a lot of us do tap and go in restaurants and cafes. A lot of them are Tyro machines, aren't they?
That's right. So the thing is, the people that they deal with, or the companies that they deal with, tend to be very large businesses or even just small to medium size enterprises as well. They did a very good job initially in locking up many small to medium sized businesses where the margins are very high. Yeah. But the growth rates in that area are starting to slow, and one of the concerns is that as they get on larger and larger merchants and companies, they're going to get squeezed. Yeah. So will they be able to maintain the rates of growth that people have gotten used to? That's one concern. Obviously as well, with this coronavirus pandemic, people were concerned that volumes of transactions were going to decline and that value of those transactions declines as well. And we've seen in an update, I think today, that the volumes have been pretty flat, but the basket of items, the basket of goods is actually now smaller. And again, it's a question about how quickly things can return back to where they were before
However,
the
the
crisis.
market is like in their future.
Well, that's right, because if you come back from $4 to $1, $1.50, obviously a lot of people are going to start to look at that. And I think at the moment people are buying those companies on their previous growth trajectory and the expectation that that growth trajectory is going to pick up again once we pass this little blip. Time will tell.
And I guess if you believe that all of us being locked up are desperate to see the return of Friday and Saturday nights at restaurants and pubs, Tyro will be a beneficiary when that happens.
Absolutely. They did actually get a bit of an offset with people going and stocking up on toilet paper and goods and service, goods for their house to keep them sustained throughout this period. So they did see actually a bit of a pickup in the volumes. It's just that people weren't spending on shots down at the pub. They were buying toilet paper, which was cheaper.
All right, we'll save your favourite for last. McPherson was an interesting one. We interviewed the CEO here last week, and I was actually quite surprised at the diversity of the company, and once again, its graph looks like all the other companies. It's a really big bouncer. What do you think about McPherson?
Yeah, look, I must admit it wasn't one that I was too familiar with before, but after looking into it, it is an interesting company. It's almost a diversified conglomerate, mini-conglomerate in some respects, because it covers everything from aluminium foil and glad wrap to health and beauty products. Even
like the nail cutters.
The nail clippers and the files, all that stuff that you see in the chemist.
The stuff that gets stolen off us at the airport when we're going through.
All that sort of stuff. So they might have seen a bit of a tick up, or they didn't see a bit of a tick up as people, again, stocked up their pantries and their cupboards at home to get them through this pandemic. But for them, I think the main driver is this product called Dr. Winless or something. I can't remember the name there. But
Whispers or something?
Yeah, basically it's their skin and beauty range, which is seeing enormous growth into China. Not only that, they're seeing 50% growth domestically, 250% growth overseas. So there's something to like about that business. That business.
They've got products for the now when we're locked up.
That's right.
And products for when we're not locked up.
Well, that's right. So at the moment, their main driver of growth is the things that you thought would have been more mature for them, the foil and the nail clippers. That's obviously seen a bit of a bounce in the short term. The health and beauty stuff's probably taken a little bit of a back seat in the short term, but in the long term, you want to see those dynamics shift, because ultimately it's the fast growing brands that make a big difference for them.
And they were a mining services company at one stage, I believe.
Yeah, look, it's a strange business taken on many different many different forms.
Yeah. Okay, final one, Elmo, and it's not for people who are Sesame Street fans. Elmo means a lot, means other things. But Elmo is a company you like. In our microcap conference in November, you tipped it. It did very well. Explain what it is and why you still like it.
Yes, so Elmo tipped at the conference. Fortunately, it's higher today than it was then, despite all that's gone on. It's one of these software as a service, fast-growing tech businesses that provides services to HR departments when it comes to payroll and rostering. It's got a 10% market share. So basically, any business in the country is a target customer for them.
For payroll.
For payroll and things like that. And speaking to the management last week, they suggested that although a couple of companies have put off that final decision-making process in this environment, what they have seen is a lot of other businesses coming to them looking to move into the cloud, so to speak, and away from more traditional payroll mechanisms, which can often, in the office, done through paper or whatever it may be. So they've got clients ranging from universities to many big electrical and technology companies. It's founder-led still. I think the two founders own 30-40% of the company still.
That?
I like that. It means they've got skin in the game. Often these fast-growing tech businesses are private equity-led, and they don't really have the networks entrenched within the industry, which I think helps Elmo when they acquire businesses. Often the businesses that they're acquiring have been set up by people that worked for Elmo in the past or things like that. So they have a bit of an advantage in our view in that space. They've got great customer retention rates. Each year, each customer spends 110% of what they spent the year before. So not only are the current clients spending more, but they're bringing on a lot of new business as well. Their margins are very high, and they've got a number of different modules, 13 in total, when the average customer only uses about three and a half of those 12 or 13 different modules. The idea is over time, they can not only increase revenue through existing customers using more modules, but bringing on new business as well.
Cross-selling to advantage. All right, so that's Michael Wayne with his look at 5, I think, very interesting stocks. Mike, your website before we go?
medallionfinancial.com.au.
Thanks, mate. Well, we've heard from Michael Wayne from Medallion Financial about these companies, and now I've asked Michael Gable of Fairmont Equities to tell us what the charts are saying about these companies. Mike, thanks for joining us.
Thanks, Peter.
Let's just start off with Tyro first of all. What's the chart?
Well, at the moment,
saying
it's
here?
telling me it can continue to head higher. So what we can see on this particular chart is obviously the savage sell-off from a few months ago. Bounced well off the lows, just like the rest of the market. But what I've indicated with the diagonal blue lines is that it did enter a period of consolidation. So strong move off the lows, and then it consolidated that move. So what that means is, any selling that came in wasn't enough to push it down to the previous lows. It was met with almost equal buying, and then in the last few days we can see that the selling pressure has subsided, and now it's having another run towards its old high.
Now, this is the kind of theme I'm exploring here, Michael, and it seems to me that the market is saying that eventually they believe Tyro's future's good, and even if we got, say, for example, a second wave and another savage sell-off, it kind of tells me, if you're an investor, this is a company that would always be a good buy on any such, say, second sell-off, savage dip. What do you say?
Yes, I mean, what we've seen in the last week, or what I've noticed, is a clear breakaway between, leading companies within their sectors and the rest of the market. So as we know, the Australian market in the last month hasn't made any ground at all. It's stuck in a range. But there are a select number of companies in the last few days that have broken out of that range and are actually heading higher. So this stock is one of them. Even if we're looking outside this space, companies like Macquarie, companies like Magellan, there are a number of companies out there which are market leaders in their sectors that have broken out of this range from the last few weeks and are already having a run. So the market's trying to show us which are the stronger companies out there. So if we do get another wave of selling, these are the companies that you need to be paying attention to.
Let's go to one that probably doesn't fit that bill of being a leader in its sector, namely Zip. And it has gone for a nice ride lately after Tencent has taken a very big interest in Afterpay. What's the chart saying?
In some respects, it's similar to TYR. So it had that period where it basically hit a little bit of a brick wall for a small period of time, which we can see with the horizontal blue line there. But now it's having another run higher. It is coming up to some major levels of resistance, though. So the two horizontal lines that I've got there are a zone where it should encounter just a little bit of selling pressure. But great rally off the lows. But I think the shorter term, this one might just find it a bit harder going.
Okay, good point. Our next company is EML Payments, and this is one that your friend of mine, Julia Lee, has liked for some time. She got it right in our microcap conference in November. It did well, then faced the savage sell-off that other companies have experienced, but it's made a bit of a comeback. What are
I think the
charts
chart
saying
looks
for
really
EML?
good, actually. This is one that we've also been buying back into a few weeks ago for some clients. Again, it's displaying that very nice bounce off the lows, a consolidation, and again, we can see a breakout occur a few days ago. And if we have a look at where it is now compared to the old high, not that I'm saying it deserves to be at the old high anytime soon, but at some point between here and the old high is where it may well find resistance, and that's still quite a significant amount of upside. So I think this is a really good looking chart.
Yeah, and I guess all three companies have a modern tech feel about them, don't they? And it just seems as though the market is saying those companies are the future.
Yeah, exactly. I think what's important for investors is to identify companies which can, have the most resilient earnings in the face of this virus in this new world that we're entering. Clearly there's going to be a lot of winners and losers with what we're seeing, but I think companies like this, their earnings are not going to get dented as much as as some other well-known companies.
Now, next company is a different sort of company, and it's called McPherson. And the reason why I got you to look at this, I interviewed the CEO last week, didn't know much about the company at all. I know when I talked to Julia Lee about it, she said that the mining resources company, a mining services company, which it used to be, but it's kind of got out of that and gone into a whole lot of, as Michael Wayne described it to me earlier today, a plethora of different businesses. But many of them have a bit of potential, and others are actually doing quite well because of the coronavirus. What are the charts saying about
the chart for this looks really good, Peter, and I have to admit it's not one that I was familiar with either, but I wish I was, because from its lows it's almost back to its old high. But the way it's trading tells me that it can still continue to head higher. So the reason why I say that is it hasn't just gone from the lows in March all the way back near its old high in a rush. What it's done is it had that initial bounce, like some of the other companies, consolidated that move. So what I've indicated on the chart with the diagonal blue lines is just that consolidation. So this is known as a flag formation in charting. So we've got sellers now stepping up, but being met with almost equal buying. So the share price therefore hasn't fallen all the way back. It's sort of steadied around these levels. But now it's on the move again. So anyone that was going to sell the stock seems to have done so. And now it's ready to head higher. So I think this one will be touching its old high pretty soon.
It's funny, Michael, whenever I throw a few companies at you, I never ever get 4 thumbs up. But it looks like we've got 4 thumbs up.
Well, I mean, the market, I'm still quite optimistic on the overall market. I think there's further upside. It's doing really well. And, at the moment, look, most companies are still recovering. I guess if we're chatting again in a month's time, a few of them might be turning a corner. But for the moment, I think a lot of these companies still have some more upside.
Well, here we are again, socially distanced as we're supposed to be, but the market keeps on going up. And I've got to ask the question, is this too good to be true? Charlie?
Well, I think potentially aspects of it are, Peter, not everything. I think that in stuff that I look at globally, there's been many justified price moves in terms of, software companies, world's leading tech companies probably deserve to be where they are. But I do feel some of the rebound trade based on a sort of V-shaped recovery when this all ends is a little optimistic. Yeah. So I don't think it's all too optimistic. You've got to remember, the biggest stimulus you've ever seen in peacetime has been thrown at this. So you've got really cheap money, huge government spending, huge unemployment, and markets in parts probably a little bit ahead of themselves, but not all of it is, Pete. So I'm a bit 50-50 on that.
Paul?
Well, I think when the market does what the market does, Peter, it goes too far one way and too far the other way, right? Yeah. And this is sort of like we went far too far on the way down, and we've probably gone too far on the way up, as everyone thinks it's all the worst is behind us. I think it's actually going to be a really tough 12 months. And we'll be looking back and this and thinking, well, now we understand why earnings are much lower. So I think the rebound probably has been too hard, but it's come off a very low base, Peter. And markets, I think Charlie has been saying on this program for a number of weeks, particularly in the US, there's so much cash around, it's got to find a home. It's what it's been doing. It's been buying shares.
I think the other thing is it's not just the cash on the sidelines. A lot of people put on short positions in March. So there's been a lot of shorting of individual stocks that were seen to, we're entering the Great Depression. A lot of index shorts were put on as well. And that has been quite painful for people who put those on. So I think you've seen a fair bit of covering of that as well. So a bit of what we've seen recently is a bit of a short squeeze too, actually, as well. So
I guess the bottom line is this. Charlie, are you thinking to yourself, if we do see in America a second wave threat, that the stock market will get really spooked when they see that?
Yes, definitely the second wave is the biggest risk we've got. Also an increase of tensions between America and China. They're the two biggest risks we've got. Yeah. Now the markets have been very easily found the path of least resistance lately has been up. People are lightly positioned, but that could quickly change. So, I mean, I'm no expert on second waves or anything like that.
No,
I do see the rhetoric between the US and China is picking up a bit, and it does worry me, just in terms of where we are and trade deals and payback for all this. So look, I think where we've got to, I mean, the risk reward's not fantastic where we've got back to, I'd suspect, and I'm still running a bit of cash, just waiting for our moment.
Yeah.
You know, we might get a chance.
I think there's probably a third risk, Peter. That's the political risk in the US. I mean, I think 2 months ago we would have said, look, Donald's home and hosed, right? Doesn't matter what happens. That's changed a little bit. I don't know. Look, I got no more insight than anyone else's about this, but will worry the markets. A Democrat president won't be as pro-market and market eyes. So they get, if that electoral cycle just turns a little bit and they start to worry about that, we're going to get into those.
But wouldn't Joe Biden be more likely to be a conciliatory president with
probably,
the Chinese?
But still, Wall Street's very one-eyed about this, right? I mean, and so they're going to be much more sympathetic and much keener upon a Republican. And we'd like to see as well, not just they want to see a president who also has got some influence over the different houses. So, I just think that's another risk you might throw up there. But as Charlie has said, I think it's the money, some short positions. And markets, as we know, always looking way ahead. You know, we were over the coronavirus. Now it's about the recovery. Markets have been pricing.
Excuse me for being a historian, and maybe I might be reminding you of something as well as you, Charlie. That hasn't it surprising the US stock market actually done better under Democrat presidents like Clinton and Obama than they did under Republicans?
Well, Peter, I think you're the expert on that. I'm just saying that, look, it's the fear of the unknown.
Yes.
It's a fear of a change, and that's just the way Wall Street will think initially. Doesn't mean it'll work out that way.
No. I mean, the markets right here, right now, have not got to the presidential election. They will. They definitely will.
Yeah.
The markets at the moment, as far as I can see, really price the present or the flatness of curves or whatever's going on.
Yeah.
And they'll find something else to focus on, and the US election is a big event, there's no doubt about it.
Okay. Paul, you made a point that some of the stocks that Charlie often talks about, like Microsoft and Apple, they've done really, really well, but a lot of other US stocks haven't done it quite as well. Right. Are these tech stocks over beautifying the picture than it really is?
In some cases, because some that do depend on advertising for revenue, more like perhaps the Facebooks and some others and Googles and the thing. If the economy's slow, there's going to be less advertising. It's always the first thing that cuts, right? Marketing expenditure is the first thing business cuts when they need to save costs. So I think it's possible to say that some of those companies might be over the top. I think Charlie's been very keen on Microsoft. That's a different proposition, right? That's software everyone needs and a cloud business that everyone's using. So, probably that's not impacted too much by a softer economy. So I think what the point you're making, Peter, is in America it's the Amazons, Facebooks, Microsoft, Apple, Alphabet. They're all up at almost near all-time highs, and higher than the start of the year. Whereas, and we've seen that affect.
Where US bank stocks are.
Yeah, but that is justified. I mean, Amazon's business is dramatically better than it was at the start of the year. So is Netflix. They're both at record highs. Microsoft is very similar, if not stronger. Apple's a little bit worse off. But the key differentiating factor, and I don't doubt that there's some cyclical elements to those companies. Absolutely, right. And they are affected by a US economic recession, whatever you want to call it. The greatest advantage they have, as I've stressed in the notes and in these presentations, is balance sheet. Most of those companies have between 20 and 150 billion of cash on their balance sheets. They can see through any downturn. It's a bit different to Flight Centre coming to me for an emergency capital raising, to stay in business. So I know that while those large cap tech stocks have done very, very well, and the Nasdaq is up now for the year, which potentially is a little bit ambitious, you've got balance sheet behind you. They will not need the government, and they do not need any other investor to bail them out. And that's the difference between US banks, Australian banks who've come cap in hand, the Flight Centres of the world, and what is going on in US tech. But I wouldn't argue that they've had an almighty run, and they could have a pause.
Okay, and you brought up the subject of banks, and Paul, the banks look really crappy at the moment based on provisions that might not be necessary. Could the banks actually say, for example, if there isn't a second wave and the government can get out of JobKeeper earlier than expected, could the banks be like the kind of companies that come home in a wet sail in
I
this
think,
year?
Peter, if you look at what's happened, I mean, the whole market sort of got sold off. The banks went a bit further. The companies that went hardest recovered first, particularly some of the tech names here just following on from the US lead. Banks have basically sort of stayed relatively still as they've upped their so-called COVID-19 provision. So if you're a believer in sort of the V-shaped recovery, you should see a bit of a V-shape as well with bank share prices when the market comes back to it. But at the moment, the markets, I still think in Australia, at least out on the extent of just whether the banks have actually provided enough. So that's sort of the unknown there. So I think there's probably a bit of value there, Peter, but it's not. We're not seeing the lead in the US, so therefore we're not seeing it here in Australia. So
European and US banks are also struggling in terms of lagging the markets quite badly, as you'd expect in the lowest interest rate environment in history. It's very hard for them in a flat yield curve to actually make money, borrowing short and lending long when the yield curve's flat. So that's a bit of a global event, but obviously with the local dividends being deferred, if you want to call it that,
Let's hope they're deferred.
Let's call it deferred for the moment. We don't know.
Yeah.
Look, the point is though, that if you have your optimistic scenario, we all go back to normal, JobKeeper goes, everyone pays their mortgage again, are banks in Australia going to rally? Absolutely.
Yeah.
But I just don't know where we're at with all that yet. I
No,
don't think
me neither. That was just a hopeful
if you're on that side of it,
throw at the stumps.
Yeah.
But we don't know.
We don't.
And the second wave
it's really finger in the air stuff. The provisions, Peter, are finger in the air. A whole lot of scenarios, but who would have said a month ago that the US unemployment rate would be 14.6%? So for bank economists at the moment saying that next year, that housing prices are going to fall 15% this year and 5%. That's just finger in the air stuff, right? That's all it is. And so, there's no idea at this point in time. So it'll take a long time for those sort of numbers to really go through the system. So I think, as Charlie said, if you believe in the V-shaped recovery, then banks are going to look pretty cheap.
Yep.
If you think this recovery is going to take a lot longer, question mark whether the banks actually have done enough.
Okay. Last thing before we go, we always like to get a stock of what you've bought or what you got your eye on, Charlie. What have you got your eye on or what have you bought?
Well, the only thing I've done in the last 2 weeks is actually buy a bit more of the greatest investor of the 21st century, Berkshire Hathaway. I think his stock looks interesting. It's the first financial I've added in 5 years.
A or B?
B.
A's a bit on the expensive.
Well, A's a bit much, right?
Yeah,
Not above Charlie's pay grade, is it?
I mean, they're back at the net asset value. Remember, he's got 137 billion in cash.
Yeah.
He's very well positioned. 17% of the market cap is Apple shares. He owns some big money centre banks in America, Wealth, some Coca-Cola shares, American Express. I see it as a bit of an ETF on America reopening, plus his skill to deploy that capital. So that is the only thing I've done in the last few weeks. And quite frankly, over the last few weeks or months, if you've done nothing much, you've probably done okay. The temptation to overtrade these situations is very large.
Okay, Paul?
Look, a boring stock is the Arena retail industrial property trust. It is boring. Look, they did a capital raising last week, but reconfirmed guidance for the full year. I think that's...
what's their most famous thing?
Peter, I don't know, but you caught me off guard with that question.
Sorry about that.
So I thought quickly, but a yield of almost 6%, which they've reconfirmed guidance for, I think that's a reasonably low risk sort of income stock.
Yeah, great stuff. Paul Rickard, Charlie Aiken, thanks for joining us.